and get it all done. After midnight, I just have to like pack it in and go to bed. Okay. All right. Page 7. So, to be honest, there's a lot of information in this course, and I can't cover everything that I would really want to. Like some of it is not necessarily required by the province, but I would like you to know some of the things for just in general in life. And so there's something called, anybody know about like the latest? This is going to be way at the back. I'm just going to let you know about it. I'm going to use my other booklet here to show you. Have you heard of the first home buyers plan that the government rolled out just this year? I wish I would have been able to use that for myself, but where is it here? You don't have it in yours yet. I just looked this up. It's called the First Home Savings Plan. It's brand new. So what's so special about it? Um, it you can open a first home savings account and put in 8,000 every year, but the maximum is 40,000. So if you put in 8,000 every year, you can have up to 40 grand in there. And this is all tax free. So what that means is if you were to make 40,000, let's say 1 year, you're working, you're making 40,000 and you put 8,000 that year away into this account, it will look as if you only made $32,000 that year. What does that mean for you? A nice fat check back during income tax time. And if you take that check and don't go blow it, you can put it right back next year into this again. You'll get another big fat check. And it's just so there's like the benefit of not getting taxed and getting money back at the same time. So you can make this grow a lot faster. And then so 40,000 is like the max. So, but if you and your partner down the road, you both want to buy a house, you can actually both have 40 grand in separate accounts and then use 80,000 towards a down payment for your new home. This is the beauty of it. Right, you have to be 18 and older, of course, to open it. So you can't, most of you can't open it just yet, but don't open it too soon either, because you can only have the money there for like 15 years, and then it will turn into like a retirement plan. But right, like so 15 years is still a long time, but I wouldn't open it just yet. When you're closer to that point, you see yourself buying it. But again, you have 5 years to do that. So if you open one today and don't put any money in there, every year you'll have like $8,000 worth of space to put in there. So let's say you open one today and you don't put any money in there for 5 years. They will say, well, you have $40,000 to put in there whenever you like, right? Like the 8,000 per year builds up. So it's new. I'm still learning more about it, but I think it's sweet because you know what? I did the same thing with my RRSPs. I don't know if you know what that stands for, Registered Retirement Savings Plan. I was able to do the same thing with my RSPs, but guess what? I have to pay that back. So this one, you do not have to pay back. You can just use it to buy your house and then you don't have to pay them back. So you saved on all the taxes. You're probably going to earn some interest on it. Wherever you put it in, you're earning interest. And so it's just an amazing plan. So you may forget even what it's called, but remember this, that there is something out there that helps you save up money to buy your first home or condominium or what have you, right? So it's called the First Home Savings Account. Okay. I'm wondering if I should give you a very, very short. I feel like you're so new to this, and I'm just assuming I'm talking like as if you all know what it is that I'm doing, right? So let's say you make $40,000 a year. Okay, you get taxed probably about 25% of your check. Well, let's go 20%. So your taxes for this year would be about 8 grand. It might be a little bit less, it might be a little bit more, but let's just say technically year one you would be paying $8,000 worth of tax. But you're like, right? I'm gonna save up. I'm gonna take 8 grand away this year, put that into a first home savings. You can't see that, can you? What is it called? Plan or yeah, I think so. You put the 8,000 in here. Okay, you put that 8,000 in here. Now it's as if you only made 32,000 this year. You just gotta make sure you do it on time. Don't let the year go by and then I really wanted to do this. You need to put it in before the end of the year. What is 20% on 32,000? That's 6,400 tax. 6,400. So the government will say like, wait a minute, you only made technically because you put 8 into this account. It's as if you only made 32,000. 20% on that is 6,400, correct? So they have to give you money back. So you just go minus 8,000. You're gonna save tax savings of 1,600 bucks. Okay, so the first year you will get about this much back if this is your situation. You put that in here as well, right? You put the 1,600 in there, and then year two rolls by, you still make 40 grand. You would technically pay taxes of 8,000 on it. Okay, but guess what? You still put 8,000 away, right? Technically, you can't put 8,000 in there anymore because you've already put the 1,600 in there. So what are we at? 6,400. You can only put 6,400 away the second year because you already placed that in there. But you've got 9,600 in here. So what's 40,000 minus 6,400? That's 33,600. If you were to pay taxes on that, 6720. You still save, right? You go minus 8,000. You still save 1280. Like that's money you worked for that you're getting back. You put that in there as well. 1280. Right? So this is money that you would have technically given. You would have technically given that to the government, but now you're like, hey, I want that back, right? Because I'm saving up money. And also the 6,400. Okay, so at the first year you have to come up with the 8 grand all by yourself. Okay, but then the second year you take advantage of the taxes you get back, and it just keeps adding, and you grow faster and faster, right? So with less of your own money having to put towards it, you use some of the taxes you get back. Hey, if you're like, you know what, I'm gonna go 8,000 every year, and I'm gonna spend the taxes on a vacation. I'm gonna go somewhere, have fun during the summer or winter, whatever. You can do that too. At least you get the benefit from it, and you're not just giving it to the government, while at the same time saving up for your future condo or home or whatever. I have to read it up. What happens if you don't use it for a house? I guess you would have to let it sit in there for 15 years, I'm thinking, until it turns into a registered retirement savings plan, in which case you can start withdrawing, but you're going to pay taxes on it. So you kind of need to make sure you want to buy a house and maybe ask your bank. They know way more about this. If you go and ask them, I want to open one of these, they will tell you everything. You can make an appointment with the financial advisor or a loans officer or whatever the titles are these days with your bank. You make an appointment, and and you just ask them about it, okay? So you can't say you don't know, right? You have more knowledge now. That's very important to have that knowledge, okay? Back to page 7, and if this was a little overwhelming, I apologize. I didn't really prepare for it, but I wanted to mention it because I was talking to a young university student yesterday, and he was planning on buying a house, and he actually is going to open one of those. So I thought I'd mention it to you as well. Page 7. Why would a person tolerate risk in an investment? Anybody? Why would you be okay with some risk? Higher return. The higher risk, the higher your potential return, because it could crash, right? Yeah. Mhm. Yeah. Higher risk usually gives higher returns, and that's in the notes as well. Okay, um, so that's something that concept that I would like you to know. Potentially, okay, potentially, because it could crash. Actually, if you risk more, you're probably risking of losing money. Like I lost money during the COVID. When COVID hit, like my portfolio lost money. But they always think if it's retirement that you're saving for, just think long term because you will lose along the way, but over time you're going to gain that back. You don't panic and just withdraw all your money because you're going to end up hurting your efforts, okay? What is the benefit to a market-based investment as opposed to a fixed rate, such as a GIC or bond? Market-based is stock, right? Stocks versus fixed rate is like savings accounts and so forth. Yes. Fluctuates, but usually provides higher returns. In fact, did you know that the market going up and down is the reason that you make money with the market? Because you want to buy stocks when they're low and sell them when they're high. So if the markets would just go up, 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 you can never buy at a point where you can, right, like low. You kind of like people when they buy low and then sell high is kind of a way they make money, right? So if you can think of the market as this, you want to buy here and you want to sell here. And when you buy when it's somewhere in the low end, and you're like, well, how can you predict that? Um, there's software out there that has been keeping track of the trends. So some people are actually able to predict quite accurately when to buy, when to sell. What time of the year do you buy? What time of the year do you sell? If you don't want to do that, have you heard of Questrade? Questrade, if you watch the NHL, the ads are on there all the time, right? If you watch the playoffs, Questrade. So that's an app that does this for you. It invests for you. So that's something you can look at. Um, so fixed rate usually, I'm going to use some fancy words here, yields lower returns. Yields is the same thing as gives, usually gives. Yield is something that we talk about when it's like profit. Some advantages of diversifying your investment portfolio. I want you to think of um, it protects from um, losses You don't invest all your money into one stock or company. Okay. Not all the money, not all funds are in just one type of investment. So some people might have some cash in their checking account, they might have some in their savings, some in the retirement savings plan, some of the money is for stocks. And Nick, you were saying some of the extra cash that you have is like, you know what? I'm okay to gamble a little bit with this. I have all this other stash here. I've got my safe stuff. I'm going to put 5 grand towards the stock. If you can, yeah. Some people can't. There we go. Uh, how should an investment portfolio change as one ages? So I would say this, if you have a continuum like this, and somewhere in here you're young, and then you're older. So I would say if this is your risk axis, right, it should go like this. Right? So when you're young, you're able to risk more because if you do lose, you have time on your side to regain what you've lost. As you get closer to retirement, right, you want to decrease the risk, right? Low risk, high risk in general. And you might say, I don't like risk. Like if you're like my wife, when we sat down with our advisor, she picked everything low risk. Like I don't want to risk anything. So she's like low risk, low risk. So she doesn't mind not making as much percentage wise, but she just wants to make sure she's safe. So I'm kind of like in the middle somewhere. But when you look at age, like it's okay to be higher risk when you're younger, but as you progress, you should move most of your assets to low risk. Because when you lose it all, you're close to retirement, you don't have that time to gain it back. So that's one of the things that I really need you to understand. Give examples of kinds of investment portfolios a person might own. So example one, okay, you might have some stocks, you might have some bonds, you might have a tax-free savings account, you might have an RRSP, okay, and some. Do you know? I think you know about the RESP. I'm thinking because your parents may have started an RESP. It's for education savings plan that that you can use to go to university or post secondary. So this is an example of someone. Example two, I'll just add here. I'll say real estate. You may know someone already that, or maybe your parents own more than one property and they rent it out to make extra, right? Like, because they know that the value of that property is going up, the rent pays for the mortgage, and so that's how you build wealth, right? You could have, gold. You could have the first home buyer's plan or something like that, right? So the sky's the limit. Just a regular savings account. So a portfolio is just basically, hey, if you had a folder and you open that folder, like how many pages are in there? And every type of investment is like a page, right? Bless you. So that's one thing I want you to remember. Okay, let's keep going. Um, hold on, I'm trying to think. if I should talk about that now, because I think it's financial terms are complicated. They're not. I always thought it's like, I'm just gonna give you all the information. Then I'm thinking about it, it's like, wait a minute, you haven't even opened one of these yet. Like, how would you know about it, right? So I'm kind of talking to you as if you don't know anything about investing, knowing though that you probably have a pretty good idea or you've heard what's going on in the world. But this is one thing I need you to understand. Um, most of these investments are vehicles. They're ways to make money. They're ways to get you from A to B. Okay, so I want you to think of them in that term, so that you understand. It's like, oh, I can put my money in there and it will take me somewhere. Okay, so think of it that way, and I think I'll come back and give you more information down the road. Here's a bit of a visual. This is on page 8. So on one hand, you have your interest or return. So it's either low or high, and then you've got your risk level, low versus high. And so as the risk goes up, so does your return, right? That's why this line is going up. And so stock market shares and mutual funds are kind of like on the high risk, high reward kind of spectrum. And then GIC, do you know what a GIC is? You got to watch my lesson on the first. It's a guaranteed investment certificate. You lock in your money, and even if you don't watch it, you just want to read it. Right here on page 5, there's the GIC, guaranteed investment certificate, and the rate of return is fixed, and the term is fixed. So you gotta, if you didn't highlight anything else, GICs, I'm going to talk a lot about GICs. You cannot, once you lock in, you cannot take the money out. You have to leave it in there for the amount of time you sign for. The higher the interest rate, the longer you have to leave it in there. Okay. So I just signed for a 5-year GIC, and I got 5 point something percent, which is really high. It's a really good interest rate because the interest rates went up, which is bad if you owe money. It's good when you want to save because you get more paid. Okay. Um, okay, I'm going to leave it like that for now. Come back to this down the road. Let's do some math here. Page 9. This is called simple interest. Here we go. The amount of interest an investment earns based on only the principal. This is the important part here. If we graph the amount of simple interest earned as a function of time, it would be a linear function. Okay. Where the y-intercept is the starting principal and the slope is the interest earned. When using the simple interest formula, I will use a different color for this part. Time must always be expressed in years. If given the months or days, you must convert to years. Use the fraction as a way of keeping all the decimals until your final answer. Okay, so when you're given like, hey, find the interest earned after 420 days, all I want you to do is write it like that, because there are 365 days in a year. So now it's actually, you can say years. It's 420 over 365 years. If it's months, you'll say, okay, 30 over how many months in a year? 12, right? And so you've turned it into years. Sure, you can turn it into a decimal, but I want you to use all decimals. 36 weeks. How many weeks in a year? 52. 52. Yeah. Um, there are, I'll just do this. You might call me crazy, right? 52 weeks, 12 months. Um, Given that there's 52 weeks, there are 26 bi-weekly periods in a year. Because if you go every 2 weeks, then it'd be half of 52. And there are 24 semi-monthly. This is going to come back later. Semi-monthly periods. Okay. So I don't know. Put this on your study sheet to be safe if you struggle with that. And here's your formula for simple interest. So the simple interest formula, you can't forget that. At your age, you would say, I love to party. Okay? I don't know if that sticks, but I equals PRT. Where I is the interest earned or paid. It's a dollar amount. P is the principal, which is known as the original or initial amount, also a dollar amount. The R stands for rate of interest as a decimal. So you got to make sure you divide it by 100 if it's percentage. And T stands for time in years. So there we go. Okay. Recall that in general, I talked about this in the first lesson. Future value, like how much you're going to have in the future, is comprised of principal plus the interest. And so future value that's the formula, and I break it down here. This is what it means. A is equal to P plus I. You can rewrite the formula above, so this formula like this. Okay, so if A is equal to P plus I, come on, keep on breaking this. There you go. If this is true, watch what I'm going to do here. This I here, you may have calculated it before using this formula. So I basically take that I and plug it in here to make a bigger formula even. Can you see that there? I went arrow from this I and I'm going to plug it in here. So that results in A is equal to P plus PRT. They're all multiplying. This one is fine as is, but you can actually factor out the P. So that gives you A is equal to, take the P out, so you're left with 1, right? If you take the P out here, plus R times T. It just prevents you from having to plug in the principal twice. Okay. So this is the formula. Alongside this one up here, I would have both of these on my study sheet. What's the difference? What is the difference between this one and this one, Mr. Dirksen? What is the difference? This one will tell you how much money you have altogether. A is the future value. This one up here only calculates the interest you've earned. Only interest. This one will tell you, hey, whatever you put in plus the interest. Okay. Calculates total including interest. Only interest. But it turns out that we can also manipulate these formulas to solve for something that's missing. Okay? to make a note here. I'm going to use a color that I haven't used. This is important. We use this formula right here. Use when two variables are known and I equals PRT. Okay. So have both of these formulas on your study sheet, I equals PRT and this one. Go ahead. Next, rate of return. The ratio of money gained or lost expressed as a percentage relative to the amount invested by the owner of the investment. Note, this is not necessarily dependent on the amount of time involved. Let's highlight that. So rate of return as a percentage can be done in either one of these ways, okay? Both of these are saying the exact same thing. You take your future value minus the initial value, principal, and then you divide it by the initial value. This, when you subtract what you have in the future, right, what you have at the end, minus what you started with, this is the interest. This is the interest earned. That's why I just rewrite it one more time. Because if you do know the interest, all you have to do is take the interest divided by the initial value. Okay? And always times 100. Don't forget that part. Highlight this part. An investment with a greater ROR is better, since you gain the most compared to the initial amount. This folks is the standard by which you measure an investment. Because you can tell me, oh, I gained $20,000 over 5 years, and somebody else says, oh, I gained $100,000 over 30 years. It means nothing. You gotta compare. You gotta do this or that. Both of them are exactly the same. This calculation will tell you whether or not that investment actually produced the best results. It's this one right here. Don't forget this, ROR, rate of return. You're going to hear that on the radio when you're older, maybe even later this year, okay? Here we go. Let's go to page 10 and do some calculating. So I'll mix it up a bit, give you some examples. Jen invests $2,500 in a GIC at 2.5% simple interest. So a couple of things here. Invest 2,500. There's a 2.5%. Notice that word simple interest. Simple. We are in this category because tomorrow we'll talk compound interest. Simple interest, that's where we're at right now. But it's 22.5% simple interest for 10 years. Calculate the interest earned at maturity. What does at maturity mean? At the end of the 10 years. Okay? This investment is set to mature, to end after the term, which is in this case 10 years. If it had been a 5-year, then obviously after 5 years. So this is what I would ask you to do. Do an inventory, IPRT. If you're able to fill in most of these, like 3 of these items, you can use the I equals PRT formula. Do we have the time? Yes, we do. Ask yourself, is it in years? Yes, it is. Okay, good. Rate, do I have that? Yes, it's 2.5%. I don't want it like that. I want it as a decimal. All you do is you divide that by 100. divided by 100, you get 0.025. What's the principal? It's the amount invested. So that's $2,500. Okay, that's the principal. The principal is what you start off with. And I is what they're asking me for. I can use I equals PRT. Okay. I is equal to 2,500. This is the easiest scenario, to be honest. Okay. Times 10. So you grab your calculator and just go and plug that in. 625 bucks. Interest is usually has a negative connotation, but if you're saving, interest is good. Interest is what you earn without doing a thing, just having it sit there and it's earning interest for you. Show two different ways to calculate the future value of the investment at maturity. Method one. A, that's what we're after, is P plus I. This is the easiest way in this case, to be honest. What's my principal? It's what I started with. Interest is 625. So that's $3,125 is your future value after 10 years. Okay, so we earned $625, which means that in total in our bank account, we are expecting to see this amount on our statement. All right, longer method. Why would you do that, right? Just so you see that it's connected. Method number two is using that the uglier formula, I would say. This one. Principal is 2,500. 1 plus, what is my rate? It's this, times time, which is 10. And here you have to be careful. Notice the bracket, and then it's going to come another bracket. This bracket corresponds to this one here. So I'm going to make it a little bit bigger. And inside, you've got a whole bunch of stuff happening. Do it in steps. You can actually just go 1 plus 0.025 times 10. It'll be all right. The calculator can handle that. And now you go multiply whatever you got by 2,500. And there it is. Whichever method you used in this case, both arrive to the same final conclusion. Okay. What does this this formula is obviously if you want to go straight to the how much you have at the end. If you just want the interest, you got to stick with this one. State the rate of return of her investment. Rate of return is interest over principal or initial value. I already know my interest, which is 625. What was her initial amount that she put in? 2,500, correct? Multiply that by 100 and you're there. 625. So her rate of return is 25%. So if you now looked at another investment of hers and did the rate of return for that investment and you got 20% there, you would say, well, this investment was better because it's a higher rate of return. Okay. Next, if she wanted $3,500 after 500 weeks, what interest rate would she need? Okay. Okay. When you're not sure, we're in simple interest territory. I will do the inventory here. If I have 3 of the 4, I can use that formula to help me out. Okay? So you have to be a bit creative here. What's my time? 500 weeks, right? I can't have that. So I will go, that's 500 over how many weeks? 52, correct? So now I have it in years. What interest rate would she need? That's what they're asking me for, correct here? So that's question mark. What's the principal? Still, principal is what she started with. Because she wants 3,500. So what did she start with? 2,500, correct? Okay. Where does that 3,500 go? Yeah. Exactly. So if you start with 2,500 and you get to 35, how much interest will you have earned there? $1,000. Does that make sense? Okay, so we have to go to get the interest. I will go A minus P. So this is where you have to be creative. Sometimes you might think you're stuck. Think again. You will find out. So you need to earn $1,000 worth of interest to make this thing happen, to get from 2,500 to 3,500. So remember that, okay? You're not stuck. You just have to do some calculating. So let's use this. We can use this because we have 3 out of the 4 items. We use that formula. Guess what? I, we do know. So you put 1,000 there. P, we know it's 2,500. R is unknown to us. So we just go R. And T, it's 500 over 52. Yikes. You might think this is too complicated. I cannot do it. Yes, you can. Okay. So 1,000, this cleans up nicely. Watch. I'm going to forget about the rate. I'm just going to multiply 2,500 by 500 and then divide it by 52. Or you divide this first. Let's do that. 500 divided by 52 is this, right? Multiply that by, should I show that step? I will. So it's the equivalent of 9.61 something years. So we multiply that by 2,500, which gives us, this is my next line here, if I multiply these two, I get 24,038.46 and something times R. And what will I do at that point to just get rate on its own? Yes, you guessed it, we divide. There we go. And I'm going to go continue up here. So if I go 1,000 divided by that answer, you get 0.0416. But that's not a percentage, right? So if you want it as a percentage, what would you do to it? Times 100. So that's, you need a rate of 4.16% to make that happen. So as I said, the I equals PRT, you can use it and then just manipulate it to get what else you need. And interest is given here, correct? Okay, one more. If she wanted 2,800 dollars after 890 days at 4.25%. How much would she have had to initially invest? Let's focus on that first. So you do your inventory. Strongly encourage you to do this. Because if you have 3 out of the 4, you can use I equals party, right? The time, I know that. It's 890 divided by 365. Now it's in years. The rate, I know it. That's 4.25%, which is 0.0425. What's my principal? Still, in this case, it's asking for it. How much would you have to initially invest? That's the principal. So we put a question mark there. What about the interest? If I don't know how much to invest, right, at first, and I want this much, I don't know the interest. This is question mark, question mark. Oh no, I can't do it. I'm stuck. What did I tell you if you only know 2 variables? No 2 variables. Use, this is going to save you here. We're going to use that one. Chan, chan, chan. Comes to the rescue. I'm going to highlight that part. So let's use it. Do we know A? Yeah, it's how much you want it. Right? This is the final amount you want. So we're going to go 2,817 is equal to, I don't know what principal is. I do know my interest rate. And I do know the time. Yikes, right? You have a calculator, so that shouldn't scare you. Just use it as is. Okay, and then you close it there. So you have everything except for one unknown there, which we will find out in a bit. Let's clean this side up a bit. I'm going to go P, don't forget about it. And I'm just going to grab my calculator and type it in exactly the way I see it. 1 plus 0.0425 times 890 divided by 365, just like that, and that's what you get. 1.103, and that keeps going. What am I going to divide both sides by? You guessed it, this number right here. So principal is going to be, right, 2,800 divided by that. So go 2,800, 17 divided by that number right there. And so the amount you need to invest in this particular case is 2,537. So slightly more than the 2,500 you had originally planned on using. Okay. So one more thing, it says rate of return here. I'm going to close this here. It's going to be tight. Do I know the interest earned just off the bat here? I don't know it. I can't just go grab a number, but I can find out. Look at your rate of return formula on the previous page. I'm going to use the future value minus initial value. So future value minus initial value. Oh, initial is principal. Divided by your principal, and then multiply that by 100. That's another version of that same formula. So we go 2537. I'm going to zoom into this. Sorry, mistake. Let's try that one more time. I'm going to zoom in. I got to take the 2817 and I'm going to subtract 2537. Yikes. I apologize for that. That's not cool. Should have given myself more space. Over, and so this number that you subtract by the initial, it comes back here. You're comparing your interest to what you started with. So it's 2537, 24. So let's do the math there. I'm going to do that for you here. So you get 262.93 divided by 2537, 24 times 100. The rate of return is 10.36%. The RAR. Has this investment done better than at the beginning when we did the other rate of return? You got 25% earlier, correct? 10.36 here. So the other one has done better compared to this one. Even though you had a higher interest rate, this one did better. Okay. I'm going to ask you to work some, given all this information. So we're going to just get you to practice what we did today. So pages 11 and on. Okay, so I'm going to go to the next page here, go to 11. I'm going to post 11 to 15 because that's all of those pages deal with that. Simple interest. You're like, there's nothing simple about that. It's just the name of it. Let me just see here. 11. Yeah, 11 is good. If you could do 11 to 12, you will have a pretty good idea. But I'm going to post everything from 11 to 15. Okay. That's it. So if you spend 10 minutes just trying some of these before you go, so you kind of at least have tried some of them,